According to supply managers in the 9 Mid-America states, how is the economy performing?
According to our survey of supply managers in manufacturing in the Mid-America states, the 9 Mid-America states, here we surveyed for September, and this is of course our October the 1st release, the first business day of the month. The overall reading was down, again below growth neutral. The September reading was 48.1. Of course, these indices range between 0 and 100, 50 being growth neutral, so that's below growth neutral. That's the 5th time this year that it's been below growth neutral. So what I can say pretty confidently is the regional manufacturing sector is slowing down. Negative growth right now, but only slightly negative, much like the U.S. number. The U.S. number manufacturing has been losing jobs, 33,000 jobs lost at the national level since the beginning of 2024. What we're seeing is the overall reading is vacillating above and below growth neutral, but it's certainly hovering around growth neutral and more likely to be below growth neutral. We ask about the greatest challenges going forward, and interestingly enough, 39.1% of the supply managers said that higher inflation was their number one challenge going forward. Of course, that's not good from the Federal Reserve standpoint. The second greatest challenge was supply chain disruptions. That was 21.7% indicated that was their greatest challenge. Continued higher interest rates, 13.0% indicated that was the greatest challenge. And the fourth number was China, the China skirmish with China. Of course, that we're talking there about China potentially invading Taiwan. That's 8.7%. Of course, that leaves 17.5 named other factors being the greatest challenge going forward. Now here I'll bring up the graph which charts the overall reading. And again, there's in blue there, you'll see Creighton's number, and you'll see it 48.1. And later on this morning, the national number will come out, that what's called the PMI, and I expect it to be below growth neutral again. Now, we hear a lot of talk about, well, the economy's not in a recession, it is in a recession, it's going in a recession. It's pretty clear that the manufacturing sector is in a slight downturn or a recession right now, and I'll talk more about that in the other factors in our September survey here on October the 1st of 2024.
What were the hiring trends?
The hiring gauge for the month of September here on October the 1st September was 44.3, and that's down from August's 45.2. Now over the last this year, the last 12 months I should say, the manufacturing sector has lost 0.4 percentage point in jobs. Now when you look at the manufacturing sector for the U.S., 33,000 jobs now just in 2024, not even over the last 12 months. The U.S. manufacturing sector has lost 33,000 jobs. So I think we can say quite confidently that the U.S. manufacturing sector is in a recession, but only a slight recession. The downturn, what we used to call rolling recessions. In other words, the overall economy is not in a recession. However, certain sectors in a recession, and I would argue right now that the manufacturing sector is in a slight recession. The agricultural sector is in a fairly significant recession, and those, of course, are two sectors that we survey here at Creighton University. When we ask about the shortage of workers, was there a shortage of workers? Only 18% of the businesses reported shortage of workers. Now that's fairly significantly down from when we asked this question earlier in this year. So what we're seeing again is more applicants for jobs, fewer shortages of workers, and of course that's good for hiring, but not good for the hiring from the business standpoint, not good for the hiring of those individuals. In fact, what we're seeing nationally, and this is not just in manufacturing, we're talking about full-time jobs. We're losing full-time jobs across the U.S. So the jobs that are reported at the national level each and every month, the job growth is in part-time jobs, not full-time jobs. We are losing full-time jobs across all sectors combined. We're losing part-time and full-time jobs in manufacturing.
What inflation trends are you noticing?
Inflation, not so good, although the number is for the month of September, the price gauge rose to 56.6, but that's only up slightly from 56.2 in August. So what we can say fairly confidently, now the Fed has not, I can say confidently, the Fed has not conquered inflation, although it's still, the fire is still burning like a campfire late at night. It's still there. There's still, inflation is still there. We have to be on guard for that. The Federal Reserve does, and I think we're going to be concerned about that. As I said, the number one concern of supply managers in terms of economic challenges going forward the next 12 months was inflation. So there is concern out there. The Fed, I'll talk about it later, will likely reduce interest rates at their next meeting. When we look at the CPI, the all-item CPI, it's about 1.2% over the last 3 months if you annualize that. That, of course, is below the Fed's target of 2%. The core, on the other hand, which excludes energy and food, that one is 2.4% annualized, which is above the Federal Reserve's target of 2 percentage points. And when we ask about what do you expect prices, how much do you expect prices to grow by over the next 12 months? On average, 6.2 percentage points. That's much higher than would be acceptable from the business's standpoint, from the manufacturer's standpoint, and for that matter, the Federal Reserve standpoint. So again, an average growth in prices expected over the next 12 months is 6.2%. So that's a real concern going forward.
What is the economic outlook?
The outlook is a rate cut. When the Federal Reserve meets again on right after the elections on November the 6th and the 7th, they'll cut interest rates by 25 basis points. That's my expectation. Now, that means that the prime interest rate will go down by another 0.25% on November the 8th. So the prime interest rate on November the 8th will be 7.75%. It's now 8%. So that's what I expect there. Keep an eye on the Federal Reserve's balance sheet. That's, again, you can go to Google and put in Federal Reserve balance sheet. You'll see that number. That's where the Fed is called quantitative easing and quantitative tightening. They've been quantitative tightening, which means they're taking money out of the economy by letting bonds mature. Now, if they change that policy, that's really a real something to keep an eye on, because that has an impact on mortgage rates. The rate I was just talking about, those are more short-term rates, not necessarily impacting the mortgage rates. In terms of long-term rates, I expect long-term rates to move sideways to a bit down. If you want to know where the mortgage rates are going, keep an eye on the 10-year U.S. Treasury bond yields. Those are now, when Fed reduced interest rates just in this month, or let's just say September, when they reduced interest rates by 50 basis points, you will notice that the 10-year yield did not go down. It actually went up. In other words, when they're reducing interest rates, but those are short-term interest rates. The long-term interest rates those are what we control. That would be investors, that would be businesses across the globe, in fact, and they've been pushing those rates up a bit. So I expect mortgage rates to remain, they'll come down a bit, but not as much as the expectations. Where we're seeing the real opportunity for borrowers, is look at those refinancing. We're going to see more and more refinancing. That's going to be good for the banks that are doing the refinancing, but also good for the individual homeowner, and we're going to see more and more of that. Keep an eye on the bond market, though. That's where you need to keep an eye on. That's where the real action is, telling you about where the economy is going. And as I said, keep an eye on the 10-year Treasury. When the yield on the 10-year Treasury breaks below 3.6%, that's a real pointing toward what I would argue is a recession. Above 3.8, above to 3.9%, you're talking about more and more inflation, and that's a concern from the Federal Reserve. So if we see the 10-year yield going up to 3.8, 3.9%, don't count on many more Federal Reserve rate cuts. In fact, I don't think we'll see a rate increase, but certainly that'll slow their rate cutting down. And if we should see that anytime soon, then a December rate cut by the Federal Reserve is off the table right now. Keep an eye on, as I said, the balance sheet. That'll tell you, again, what the Federal Reserve is holding in long-term treasuries and mortgage-backed securities. That's now about $7.2 trillion. That's with a T. That's a big, big issue. They manage that, and that's where the Federal Reserve manages a lot of the economy, is going through that balance sheet. Now that does affect long-term interest rates, so keep an eye on that in terms of what's going on with mortgage rates. Keep an eye on the ISM reading. It'll come out later on this morning. That's for the month of September. That's called the PMI. I expect it to be below growth neutral, indicating that the manufacturing sector at the national level, much like our regional number, is indicating an economic slowdown in manufacturing. Of course, that's not good, but the good news is it's not that much below growth neutral, so I think that can manage that. Keep an eye on the price of a barrel of oil. It's now moved again back above $70 a barrel. It moved below that in September. Now we're seeing it above $70 a barrel. If that number moves up, then again, that's going to put pressure on the Federal Reserve to not reduce interest rates at the December meeting, and we'll be on the watch for other indicators of increasing inflationary pressures. Keep an eye on, or listen to, I should say, the statements by the members of the FOMC. That's the Federal Open Market Committee. Those are the 12 individuals that set short-term interest rates. That's the 7 governors of the Federal Reserve and plus 5 of the presidents of the regional Federal Reserve banks. Now, there are other members on the FOMC that don't vote, but those are the 12 members that vote. And as you probably know, last time they cut interest rates, there was one dissenting member. So keep an eye on those dissents. Not all of the individuals that are serve on that committee are in agreement right now. That's unusual. May see more and more disagreements. Watch the price of gold. That is at now record prices. And why is it at record prices? Because of fear of inflation, but also economic fear of a recession, fear of global economic turmoil. But also the price of gold is being driven up by buyers from China, from India, across the globe, filling their coffers with gold, and that's pushing prices up. Also, you'll see the BRICS. That's the nations of Brazil, Russia, India, China, and South Africa. When they meet on the 23rd and 24th of October, you'll see that they will meet, and they're meeting in Russia, by the way. They're meeting there to discuss coming out with a digital currency that's backed by gold. They're not going to be successful this year, but that's a fear we have. Now, what would that mean for U.S. consumers, U.S. investors, and individuals living in the U.S.? What it would mean is the status of the U.S. dollar being the reserve currency would be at least undermined. Now, it's not going to be changed anytime soon, but what would it mean for you as a consumer, you as a business person? It mean higher interest rates. Now, we're not going to see it right now, but that is a threat. It's also pushing up the price of gold. So that's our survey for the month of September here on October the 1st, first business day of the month. And I'm Ernie Goss here. That's our survey for the month again. And may your economic cup runneth over until we meet again on the first business day of November. Thank you.